Hi, let's discuss Fantom. If you're invested into Fantom or if you're considering to invest into Fantom, this video might be of interest to you because we will talk about tokenomics of a pretty closely tied ecosystem decentralized app. So what's interesting around Fantom is that it does look like a strong outlier over here, right? When we look at different layer 1 competitors, different smart contract platforms, we find that the market cap typically is higher than the total value locked, right? The market cap of the ETH token is almost 3 times higher than its total value locked on the chain. For the Binance Smart Chain, we are looking at a 5x more than that. For Fantom, though, the market cap of the FTM token is lower than its total value locked on the chain. And so why is that? People say that this could have something to do with Tomb Finance. And I'm also just starting to look into this. This article here will also be linked in the video description. Feel free to check it out. I'm trying to get through all of this. It's a pretty complicated system. The tokenomics are pretty hard to grasp, but I will try to make some sense out of this and go through this article together with you. So this is Tomb Finance, and the idea behind Tomb Finance in general is that you've got a token, here the Tomb token, that is one-to-one pegged with the FTM token. So it's not like a stable coin where it's pegged to the US dollar. This is a token that's pegged to the FTM price, a pretty different concept. And the accusation that this article here makes is that Fantom itself has a limited supply, right? But the Tomb token does not. And the Tomb token is simply getting printed, diluting the FTM supply, thus pushing down the price. And in the end, leading to the situation where the market cap of the FTM price is way lower than where it should be. And that's why we see this Dracula picture over here. Tomb Finance is being pictured as a parasite on the FTM blockchain. Now, is this true? Yes or no? I don't yet have a strong opinion on this, but I will go through this article together with you guys to try to come up with a conclusion in the end. Now, here's how this system works. First of all, you need to provide liquidity to a liquidity pool token. So this is something that's pretty typical. It's nothing out of the ordinary. When you go to a decentralized exchange, such as SushiSwap, Uniswap, or for Fantom, it's SpookySwap, you exchange tokens versus a pool, right? So you've got on the one hand, say FTM, and on the other hand, you've got another token. So let's say in our case, that's Tomb. And when you go to a decentralized exchange, what's happening is you come in with your token, you want to get this other token back, a swap happens. And so during that swap, you pay a fee. So in case of SpookySwap, that's 0.2%. Who gets that fee? It's the people that provided liquidity here in this pool in the first place. So you put in your FTM, you get out your Tomb token. That would be a simple swap. And in order to invest into this swapping, right, in order to profit from other people swapping back and forth, you will have to leave your capital in that pool. And so what you do is, as an investor for a liquidity pool token, you get some FTM, you get some Tomb, you lock this both up, you get something back called a liquidity pool token, an LP token, which then appreciates over time due to this swapping. Sometimes the LP token appreciates, sometimes you simply can claim another token issued by the decentralized exchange that you can then sell. They're different concepts. Now, this is the easy part. Now comes the interesting part here with Tomb Finance. You put in your FTM, you get your liquidity pool tokens. This is from SpookySwap. Now what you do with those tokens, what you do with them is you stake them in Tomb. So here in the cemetery, you will stake these tokens. So contribute to the Tomb FTM liquidity pool on SpookySwap and then stake those LP tokens in Tomb Finance in the cemetery. And when we look at this, for this staking, we currently get 88% APR. Now, is this just more Tomb and FTM tokens? No, that's paid in T-share tokens. So you put this in the cemetery and you will get back T-share tokens. Okay, let's call it TS. Now, what you could then do is simply sell these T-share tokens and then maybe buy back more FTM or more Tomb, right? Do this all over again. But that would depress the price of those tokens, right? There needs to be some utility here. And of course, there is. But let's first look at the price dynamics that happened here. You put in at the very beginning your FTM tokens for Tomb tokens in order to get this LP token, right? That you can then use for the symmetry to get all these T-share tokens. You put in your FTM, which causes an imbalance within the liquidity pool, right? There's now more FTM in here than Tomb tokens because you took the Tomb tokens out or you bind them in here. So the Tomb tokens, they in relative terms appreciate versus FTM. They go up, right? There's more FTM comparative to Tomb. But you don't want that, right? You want a peg between FTM and Tomb. And so what does Tomb Finance do now? You can go to something called the masonry. So let's look at this third step. You get T-shares, right? You get these from the symmetry. You get these T-share tokens. You want to stake them. You want to stake them in the masonry or masonry. I'm not sure how to say this word. Let's color code this with M. So a blue M over here. We send these T-share tokens back. These, by the way, they just get created out of thin air, right? Now, when you stake the T-share token, what do you get in return? You will get 1,227% APR. Paid out in what? Paid out in Tomb tokens. So by locking up your T-shares, which do fluctuate a lot in price, you will get Tomb back. And Tomb is pretty similar to FTM, right? It's supposed to be pegged. So this is what's happening. You get freshly minted, newly created Tomb. That would depress the price, right? And so because this Tomb printing depresses the price, this is not happening all the time. This Tomb printing here is only happening when Tomb is, relatively speaking, more expensive than Fantom is. So how is this overall working? New money enters the space, right? You've got your Fantom token, you put it in this LP token, the Tomb price relative to FTM is going up, and because it's going up, new Tomb is being printed that gets issued to the people that staked the T-share tokens. So new money gets in, Tomb tokens get paid to T-share holders. Now what's the next step over here? There's something called T-bonds. So we have now just looked at the case of FTM entering and Tomb being printed. But what happens when this Tomb now is being sold over here? Will the price go to a perfect peg? I don't really understand this 100% to be completely transparent here. What seems to be happening, and I don't understand the pure mechanism behind this, but what seems to be happening is that when $100 worth of Fantom come in here, or let's keep it just with Fantom. Let's not go into dollar denomination at all. Let's say 100 Fantom tokens come in here. For some reason, the price of Tomb is increasing more. Or let's say in other words, this price increase here triggers more Tomb creation than the FTM that came in. Otherwise, Tomb would never really fall below the peg, right? It looks like 100 FTM comes in and maybe it's not 100 Tomb that gets paid to the T-share holders. Maybe it's more than that. That could be the potential issue. And I don't know why it is more. But that's the only explanation I have that could potentially depress the price here. Now let's say that's the case. If say 1,000 Tomb tokens here get printed and these are then sold here in the liquidity pool, then suddenly Tomb will be below the peg, right? Which would be bad. So we don't want that. How do we prevent all of this selling? We create something new. We create something called the pit. So that's this point over here. And that's where you then have the interaction with the T-bonds. So how does that work? You can use your Tomb tokens and you can buy T-bonds in the pit. Let's draw this over here. Now, why would you do this? Because you can exchange these T-bonds for real FTM or real Tombs later down the line. So let's read this in detail. You get Tomb tokens when the price of Tomb is above FTM, right? You get it here from the masonry when you stake T-shares. But what if the price of Tomb is below, right? What when selling here happens? Well, Tomb Finance has you covered. First, the new printing here stops, right? So this issuance here only happens when Tomb is overvalued, relatively speaking. So no more Tomb printing because Tomb would depreciate more. But how can you further stabilize? You can buy these T-bond tokens. So you pay one of your Tomb tokens over here and you get one T-bond in exchange. So let's draw that. We will get 1,000 T-bonds. Tomb Finance burns the tomb you just gave to them, so the total amount of tomb in circulation lowers. So this here is gone, and instead of tombs that you could sell here now in the liquidity pool that would depress the price, you now have something that's representing tomb in a certain way. You get these T-bonds. So the price of tomb will rise up until one tomb equals again one Fantom. Okay, that's the idea, that at least the people that got the tomb from their T-shares, they're not going to sell it, and that the new inflowing money here over time will stabilize the price again to 1-to-1. At the moment, when the peg is 1-to-1, you can redeem one T-bond back for one tomb. Now this does not make sense to me at all, right? Why would you pay one tomb to get one T-bond, and then only in the condition you will go back to your peg, you can redeem again one T-bond for one tomb? This, I think, is not correctly written over here. What I expect, what's rather the case, is that you probably get some kind of discount. You probably buy the right to get a full tomb back, something like this. Maybe the current exchange rate is 0.9 FTM per tomb, so tomb is cheaper. Then maybe you can get 10% more of those T-bond tokens for your tomb tokens, and then basically make an instant profit once the peg returns. So basically, probably through this pit mechanism, if I don't misunderstand this, you're probably going to lock in your tomb, telling the system you're not going to sell this and depress the price further. And by locking this in, you get incentivized and you get more tomb in the future. And so this somewhat keeps the peg. Now, I do understand a few things over here, but I also don't understand a few others. So please let me know in the comments if you totally get this. This would be very interesting. So first of all, what I don't really get is the relationship of issuance of tomb tokens to deposits here in the liquidity pool token. Because obviously when money comes in, tomb goes up, tomb is being issued, new tomb is being issued to the T-share holders. And so maybe that's more than the money that came in. Okay. But then what I also don't understand is how this relates to the issued tomb. So when we look at these liquidity pool tokens here, the tomb FTM liquidity pool token, let's maybe look at the money that entered the system. So there are two liquidity pools, one for Fantom and one for T-share. And so the Fantoms that are locked in these liquidity pools is the money that came into the system, right? Here's only FTM versus tomb, but you can also imagine a liquidity pool of T-shares to FTM, right? The difference here is that there's no peg that's being intended between the T-share and FTM. But all the money that flows into the system, to my understanding, gets into the system via the LPs, via the liquidity pool tokens that then can get staked. But this is what this gives all value. It's staked Fantom in LPs. And so if you want to know how much money went into the system, we can simply look at how much Fantom is there in those LPs. So here's the FTM tomb pool, US dollar amount divided by 2. So that's the value in Fantom divided by the Fantom price, which is currently 1.9. So here we've got the number of Fantom tokens, 82 million. That's in the tomb FTM pool. And then for the T-share pool, we've got this liquidity, this value in Fantom, and this as the number of Fantom tokens. So we've got 22 million plus 82 million. That's the number of Fantom tokens locked up in Tomb Finance, 104.6 million. And so when we now look at the circulating supply of the Tomb token, we can see that's 223 million. So this suspicion seems to be somewhat correct. There's more Tomb floating around than FTM being locked in the system. At least if I understood this all correctly, if only you lock up your FTM via the liquidity pools and if the T-share holders get these Tomb tokens back. So this is somewhat of a 2x multiple. So this was an exaggeration over here, right? It's not 100 FTM coming in and 1000 Tomb being printed. It's rather 100 FTM coming in and 200 Tomb being printed. And so this then also explains why the Tomb price can potentially fall below the peg, simply because people could potentially sell all of that Tomb. If this is all true, right, and if it's all a correct representation of what's actually going on, would this mechanics, if there's nothing else that I'm missing here, really depress the Fantom price? I'm not entirely sure, because what's happening here is you put in FTM, you lock it up. Your FTM is not being sold for any stable coins or something like this, right? We're now looking at the FTM to US dollar price. Let's focus on that, right? That's what I mean by depressing the FTM price. You have your stable coins outside, you buy FTM with it, you lock this FTM up, and you get Tomb tokens back. You get more Tomb tokens back, or at least somebody else does, depending on if you hold this t-shirt tokens or not. One FTM becomes 2 Tomb. The FTM doesn't leave the system at any point in time. It simply stays there and some kind of magic happens around this. But then why would the FTM price in US dollars go down? The only thing I can imagine is the Tomb price getting sold to a degree that people lose confidence in this overall system and then the peg breaking. But I don't really see the case where this Tomb is replacing demand for FTM, because FTM is already locked up over here. There's no exchange happening here between a stable coin and FTM that would drive that price down. So where I do agree is that we have FTM, and I do agree we have Tomb, and we have more Tomb than FTM when we go through this magic Tomb finance machine. So I do understand that. There is some kind of inflation happening, and when the peg here is stable, then one might argue we just have more kind of FTMs around here. But whenever you want to get out of this system here, you might have to sell your Tomb, potentially depegging this. Unless, and maybe that's where all of this now makes sense, unless you can collateralize your Tomb. Let's look at this. Let's look at Geist and let's look at Iron Bank, two pretty large borrow/lending platforms. Can you actually deposit Tomb over here? So the answer for Iron Bank is no, you can't. For Geist, the answer is also no. So unless you can't collateralize your Tomb and maybe take that collateral to get some stable coins and then sell Fantom, unless that's not possible, any exit from this, right, because you now have this overhang of Tomb, any exit over here would put a stress on this peg. If you do know a way how to collateralize Tomb, then this whole argument here might actually make a certain degree of sense. So far, when I just look at this from a very broad perspective, what I think is happening is Fantom is getting in, Fantom is getting locked in here. There are some mechanics that prevent you from taking the money directly out. One of those mechanics is this pit over here, where you have to wait until the peg goes back to 1-to-1. Another mechanic is keeping that FTM in the liquidity pool to then stake it. So this is basically a big black hole for FTM tokens, and that money doesn't move yet out because people see all their returns compounding all the time. And with that lockup, with that illusion, the supply of Tomb, the selling pressure versus Fantom is not high enough to break the peg over here. So even though you've got double the Tomb, all of that Tomb doesn't really move. And thus people feel rich, but once people exit the system, the peg would break, Tomb would go to 0, and all the people pull out their FTM out of those liquidity pools. This is how I currently understand this. So unless you can't collateralize your Tomb tokens to get something else out of this without swapping this directly to Fantom, unless that's not possible, I can't really follow why Tomb Finance is actually depressing the FTM price. I think it's rather the opposite. It's sucking up FTM tokens, keeping them in the system, and giving people the illusion that they are richer by giving them these fake FTMs, so to speak. And if there are not enough people that exit the system yet, everybody is happy. And once there are enough people that want to do this swap, then the peg breaks and everybody that hasn't done this yet will lose. Now, as said, there's a big disclaimer here, right? I'm also just trying to understand this. I'm trying to understand the tokenomics, and I might have completely missed something very fundamental. Please feel free to discuss this with me in the comments. I'm more than happy to get this corrected. You might also want to consider join our public Telegram channel, which is a bit busy though. There are 1,600 people, but still it's a nice start. If you want to rather discuss this privately, we also sometimes answer with voice messages and stuff like that. There's also a premium membership over here. Of course, last but not least, consider subscribing. I publish videos regularly. Thanks for watching and see you next time. Bye bye.